important to understanding what the forward path of monetary policy will be, at least here for the first half of 2024. And so what we see here first is the Treasury issuance information that we received at the beginning of. And what we found, what has been the case for a while, you can see over here on the left-hand side, there's been a considerable amount of duration supply that was accelerating in the first quarter and has picked up over the course of the last year. And that gross supply here reported normalizing across different tenors for the overall interest rate risk is basically at highs of the last couple of years, and only was higher during periods of time where we had, the 2020 significant funding of issuance and build of the TGA. And so a lot of bond issuance is still coming. That's because there are large deficits and because the Treasury, while choosing to issue a fair amount of bills on a long-term basis, is committed to continuing to issue meaningful amounts of duration. In this case, making a clear commentary that the step up in duration issuance is what they expect to be the case for an extended period of time. And so the result we see here is that duration issuance has picked up meaningfully, which is creating, will continue to be a significant supply factor in the bond market and overall asset markets. And so just to nail those numbers down, if we look here on the right-hand side, what you see for the second quarter, this is all second quarter expected issuance, is that second quarter expected issuance is expected to be quite strong on a gross basis, 1,100 or 1.1 trillion in bond issuance. But probably even more important is on the net of duration issuance, the net of coupon issuance, which is expected to be about $520 billion over the course of a single quarter of coupon issuance. That's pretty much set. That won't change. It's possible this bills number may change if the deficit number, which looked a little low in terms of the projections, ends up coming in to be larger than expected. The Treasury will adjust with the bills side of things. But the coupon issuance is going to come, and coupon issuance of $500 billion or so over the course of the quarter is roughly double of what the coupon issuance is that we saw in the first quarter of this year, and is very high relative to history. And so that duration supply is going to keep hitting the market and keep hitting the market. Now you can see from the mix of duration supply that the Treasury is really focused on trying to keep it in the belly of the curve rather than out the curve, where it may be harder for them to get the demand that they're looking for. But still, this is going to require a fair, this is the type of flow, the type of issuance that is way beyond what anyone can front run. It's going to be day after day after day, these huge issuances. And unless there's a meaningful shift in economic conditions to shift the valuation profile of bonds, I think it's going to be hard to absorb all of these issuances. So I wouldn't read too much into that auction that occurred yesterday that went off pretty well. One auction, which is still not in the period where there's going to be elevated issuance, which is in the second quarter, not the first quarter. So I wouldn't, I'd be careful to extrapolate better financing conditions or okay financing conditions for the Treasury today to assume that will continue out for the first half of the year. So